Warren Buffett pays a lower tax rate than his secretary. Right now, wealthy investors have a problem. You bought NVIDIA at 100. Now it's at 600. You made a fortune on paper. You bought Bitcoin years ago. It's tripled. You own a business. Someone wants to buy it. You own real estate that's worth 10 times what you paid. But here's what happens when you sell. Let's say you make $5 million in profit. The IRS wants 1.2 million of that. Gone. Most people think that's just how it works. Pay your taxes and move on. But there's a different approach. Here's exactly how it works. We build a diversified portfolio. We buy a couple hundred different stocks. This spreads your money across the market: tech, healthcare, financial services, everything. But here's where it's different. We don't just buy stocks. We also make small bets against stocks that we think will underperform. This creates two sides to your portfolio. One side captures market growth, the stocks we're buying. One side creates tax losses, the bets against underperformers. We systematically swap winners and losers. Markets move every day. Some stocks go up, some stocks go down. When a stock underperforms, we will sell it. That creates a tax loss. Then we immediately buy something similar to stay invested in the market. We're capturing the natural volatility of markets and turning those small movements into tax savings. This happens every month, not just once a year. Let's say you sell NVIDIA and make $1 million in profit. Normally you'd owe $238,000 in federal taxes on that, not to mention state. But if our strategy has generated $1 million in tax assets over the past year, those assets cancel out your NVIDIA capital gain, dollar for dollar. Now your tax bill on that NVIDIA sale, zero. This tax mitigation strategy works for anything. Capital gains in stock, digital assets from the sale of your business, sale of real estate, any capital gain from any source. With estate planning, you can eliminate your tax dues. Hold this strategy until you pass away. When your heirs inherit, they get what's called a step up in basis. Basically, the IRS resets the cost basis to the current market value. What does that mean? All those gains you deferred throughout your life, they disappeared. You never paid taxes on them. Your heirs will never pay taxes on them. Tax deferral can become permanent tax elimination. Talk to your tax advisor. This isn't theory. Institutional investors and family offices have used quant-driven tax mitigation strategies for years. The math works. The IRS allows it. It's just a matter of knowing it exists. If there's a big capital gain on the horizon and no tax strategy in place, that's a 6 or 7 figure mistake. This is how the wealthy avoid taxes legally.